Today, we've been handed a stack of sources that, well, they suggest one of the most volatile retail stocks on the market is about to surprise everyone. We're tearing into a brand new, very focused analysis report. And it's all about Bed Bath & Beyond, or BBBY.
That's right. And this analysis, it's dated January 6, 2026, and it's making a genuinely attention-grabbing prediction.
You can say that again.
It's predicting a consensus among analysts for a 50% upside from its current price. So our whole mission today is to get past that headline.
Right.
We need to dissect the actual math, the technicals, and the corporate reasons behind this surprisingly bullish target of $9.60. We're here to give you the context, the key nuggets you need to understand why this thing is even getting talked about.
And the market's reaction to this was, it was immediate. And that's really our starting point. The day this report dropped, BBBY just printed a massive gain, almost 6%.
Plus 5.75%, yeah.
But it's not just the percentage, right?
No.
It's the fact that it successfully reclaimed that super critical $6 level. That's the real story.
That single day move is so much more than just a blip on the chart. Right? For those of you who followed BBBY, you know the stock has been trapped in like a doom and gloom story for years.
Oh, absolutely.
It has been hammered. It's been beaten down by fears about its business model, its debt, its entire future. So when you see a stock like that, a deep value play, or let's be honest, what some people see as a distressed asset, suddenly burst up 5.75% and clear a huge psychological hurdle like $6, it really suggests that that deep-seated negative story might finally be starting to crack.
Okay, so let's unpack the action on that specific day, because the analysis calls it a textbook bear trap. The stock opened, at $6.37.
Right.
But then, bam, sellers just took over. They flushed the price all the way down to a low of $5.96. What makes that specific move a bear trap?
It's the calculated violation of a known line in the sand. Everyone watching that stock knew that $6 was the floor for the bulls. So when the price dips just below it to $5.96, it's basically designed to trigger stop losses.
Stop loss hunting.
Exactly. You're forcing the algorithms and the nervous retail investors to sell because they assume the floodgates have opened and the stock's heading for $5.
So the second it broke 6, the panic sellers just mashed the button.
Precisely. And that's the trap. You sell, expecting it to keep falling. But here's where the buyers showed their hand. The second it hit that sub-$6 level, you had these institutional and high-conviction traders just step in aggressively.
He just soaked it all up.
They defended that $6 line with force, buying up all that panic selling. And that strength pushed the stock right back up, closing strong at $6.25 and even pushing a bit higher after hours.
So the sellers basically threw their hardest punch, and the buyers just absorbed it and threw one right back. What's the technical name for that reversal on the chart?
That structure is what the analysis identified as a hammer reversal.
Oh, hammer.
Yeah, and for anyone who's not familiar with candlestick charting, this shape really tells the story. You have this long vertical line at the bottom, the wick showing the price dipped way down but was violently rejected.
Right.
And then the body of the candle, the actual open and close, it closes right near the high for the day.
So why does that matter to the average person looking at this? Why should you care about a hammer?
It matters because it's a nonverbal signal of exhaustion. The sellers tried their best, they spent all their ammo pushing the price down, and they failed to hold it there. When a hammer forms after a long decline, it's basically screaming that the sellers are out of stock to sell, and the demand side, the bulls, have just taken absolute psychological control.
Okay, that makes sense. So we've seen the immediate price action, but now the big question, is this just a bunch of day traders playing games, or is there a fundamental, a financial reason for this massive $9.60 target? We need to get past the chart and into the numbers.
We do. And the foundation of this whole bull case is really rooted in one single valuation metric, the price to sales ratio, the PS. This isn't just lines on a chart. This is, financial math.
The report is hammering this average Wall Street consensus target of $9.60. And compared to the price in the report, $6.25, that's a potential gain of over 53%. That's huge. That's got to have some serious math behind it.
And it does. The underpinning is that PS ratio, which the analysis clocks in at a frankly shocking 0.28.
Okay, let's just pause on that for a second because that number needs some real context. For you listening, what exactly is a price to sales ratio, and why is 0.28 being called dirt cheap?
The PS ratio is a pretty straightforward tool. It just compares a company's total market value to its total annual revenue.
Yeah.
Basically, how much are investors paying for every dollar of sales the company makes?
And a lower number is better.
A lower number suggests better value.
Yeah.
And 0.28 is an extreme outlier. In this retail sector, a healthy company usually trades at a PS closer to 0.8 or even 1.0.
So you're saying the stock is trading at roughly a quarter of what its peers are relative to its revenue. That's a massive gap.
It is. The analysis points out that this absurdly low PS ratio exists, even though the company is still bringing in substantial revenue. They highlight that BBBY currently has $1.5 billion in top-line sales.
But wait a minute. If the math is so obvious, why hasn't the market corrected this sooner? I mean, what were people missing, or what was the fear that justified keeping it so low for so long?
That is the absolute critical question, and the report kind of implicitly answers it. The market wasn't ignoring the low PS ratio. It was pricing in risk, specifically the fear that that $1.5 billion in revenue was about to just evaporate.
Or that the company was going to go under.
Yeah, exactly. The stock price was acting like the company was on the verge of collapse, even while the cash registers were, still ringing.
So this 50% upside prediction isn't based on revenue suddenly doubling or something. It's just the market correcting an irrational discount.
That's it. The report is basically arguing the stock is fundamentally oversold. If BBBY were to trade at just 0.5 PS, which is still a huge discount to its peers, you'd land right in that $9.60 target range. The upside is directly tied to the belief that the fear is finally going away and the price just has to catch up to the reality of its sales.
So the technical move we saw, the hammer, was the market finally waking up to the numbers. But you need catalysts for that. Why now? What corporate moves are giving the market confidence to start bidding this thing up?
The report focuses on tangible executed actions, not just promises. The analysts point to two key developments that kind of justify shifting the valuation away from distress and toward, stabilization.
The first one they mention is the rebranding. The report notes the full rebranding to Bed Bath & Beyond is now complete. That sounds kind of like corporate housekeeping. Why does the market care?
It signals stability, finality. For years, the company was in this weird limbo, trying to shed old baggage. Finishing the rebrand means the operational focus can now shift from internal messes to external growth and marketing. It just removes a big cloud of uncertainty that was holding the stock down.
Okay. And the second catalyst is about the future. The new acquisition of the Brand House Collective, which is closing in Q1.
Right, and this is a direct injection of new business. Critically, new future revenue. It's not just about cleaning up the existing stores. It's about strategically expanding what they sell and who they sell it to.
So you've got both.
Exactly. You have stabilizing the core brand and adding new strategic assets. Those are concrete actions that give you the fundamental cover you need to justify a higher valuation than that dirt cheap 0.28 PS. The company is actively trying to make sure that $1.5 billion revenue base doesn't just survive, but actually grows.
It connects the dots perfectly. The operations are getting stable, the fear is finally breaking, and the math says the stock is too cheap. So now, let's give you the roadmap. What are the key technical levels the report says to watch?
The technical setup is pretty clear, especially after that hammer. The analysis gives two absolute must-watch lines. The first one is the floor or support at $6.
And we know exactly why that $6 level is so important now. The report says holding it is what keeps the trend bullish. It's why that little dip to 5.96 cents was called the perfect entry. It was like a gift that was immediately taken back.
Exactly. Defending $6 confirms the bulls are in charge. But for the momentum to really accelerate towards that $9.60 target, the stock has to clear the ceiling, the immediate resistance. And that ceiling is $6.55.
Which was the high it hit on the day of the report. So that's the current battle line.
It is.
So if the stock breaks above $6.55 with conviction, what does the report say is next? Where's the next stop?
This is where the analysis gets really compelling. The report states that once $6.55 is cleared, there is very little resistance until you hit the $7.50 level.
Wow, that's a huge potential jump. Almost a full dollar with no opposition. What causes a low resistance zone like that?
It usually happens when a stock has spent a very long time consolidating at much lower levels. When momentum finally breaks it out of that range, there just aren't a lot of previous high-volume trading spots, technical walls to stop it. It suggests the path to $7.50 could be pretty quick if the momentum continues.
And to back this all up, the analysis mentions that underlying momentum indicators are curling up and volume is coming back. That sounds like the market is loading the spring, so to speak.
It is. The return of volume means high conviction money, likely institutions responding to that valuation gap, is finally moving in. When you get volume and momentum aligning with a strong fundamental argument, like a 0.28 PS ratio, you get the conditions for a sustained run, not just a one-day pop.
This has been a really deep look into a very aggressive report, so let's try to synthesize the bottom line for you. The volatility in Bed Bath & Beyond is back, but the direction, critically, seems to be shifting UP. And this whole thesis, it's not built on hype. It's driven by math that shows the company is valued like it's going bankrupt, even though it has massive sales.
That's the engine, that extremely low 0.28 PS ratio. And the $9.60 target is supported by both that valuation math, the need to correct that discount, and by the technicals, which show buyers just defeated sellers at that critical $6 level.
And if we look at how the report ends, they pose one final provocative question that really wraps this whole thing up, and we'll leave this for you to think about. Given the strength of that $9.60 consensus target and the technical setup we just laid out,
The hammer clearing $6, the open runway to $7.50.
should you be considering if BBBY is actually heading for $10?
And that $10 level is the big round number, right? It's just beyond the formal analyst consensus. It's the next massive psychological hurdle. If the market keeps correcting that PS imbalance, hitting $9.60 suggests $10 is immediately in play. It forces you to ask if maybe even the analysts are still being a little too conservative.
Food for thought, for sure.
Yeah.
Especially when you keep that point